Hello, everyone, and welcome back to Lazy Genius Investing, the podcast for curious investors who want to grow their wealth without losing their weekends. I'm your host, Saveen Kumar, and today we are diving into value stocks. After learning that dividend stocks and mutual funds weren't quite cutting it, I found myself asking, what now? I didn't have a great answer. So, like any self respecting finance nerd, I turned to the gods of investing Buffet, Graham, Munger, the legends, the ones who make buying boring companies feel like a flex. So, armed with a copy of Benjamin Graham's The Intelligent Investor, I imagined building a portfolio so solid that if someone asked me, how's the market doing? I could smugly reply, I don't know and I don't care. The more I learned about value investing, the more it made sense to me. Why? One, the greats swear by it. If it has worked for some of the most successful investors, why not for me? There's a weird comfort in following a path paved by decades of compound returns, shareholder letters written like bedtime stories, and sage quotes about patience. Two, it's based on fundamentals, not hype. Unlike meme stocks or FOMO fueled moonshots, value investing is rooted in actual numbers: revenue, earnings, assets, liabilities, not Reddit upvotes. It's logical, grounded, and makes you feel like a mini Warren every time you find something that looks undervalued. 3. It doesn't require perfect timing. You're not trying to catch falling knives or chase breakouts. You buy a stock because it is cheap compared to its intrinsic value. This is ideal for people like me with jobs, kids, and zero intention of watching tickers during lunch. Yet, making it work as a retail investor was not easy. Now, I wasn't sitting on millions. I was working with a regular salary, a monthly budget, and a dream. Without zero commission brokers, I wouldn't have even bothered. But platforms offering fractional shares, global market access, and tax wrappers like ISA and SIPs for equities changed the game for me. Suddenly, I could invest like a pro with a budget of £500 a month and £20 per stock. Because let's be honest, £5 commission on each trade for a 25 stock portfolio? That would have eaten my returns faster than a toddler with a biscuit. So, a big shout out to FinTech for leveling the field. Based on my learnings, I built a basic filter system using a buffet of ratios, including PE ratios, Benjamin Graham's intrinsic value formula, 5-year growth of earnings per share, return on equity, debt ratios, you name it. Then I reviewed one company per day, usually during my commute or with a cup of tea and Excel open on my lap. It wasn't glamorous, but it sort of worked. Still, there were some hard lessons to learn on the way, like 1. Not all value stocks bounce back. Value investing is contrarian by nature. You buy what others avoid, but sometimes they avoid it for good reason. Some of my picks sold 80 to 90%, and others fell and fell and well, kept falling. Net result, better than my dividend portfolio, but it didn't feel particularly clever. 2. It is not lazy, not even close. Value investing is a full contact sport. You read financial statements, try to make sense of the industry, and build valuation models. If you don't have a finance background, a curiosity streak, and time, this is not a chill hobby. 3. You will miss the big winners. Strict value filters tend to exclude stocks like Nvidia, Apple, or Microsoft, the fast movers with high PE ratios. Yes, you skip the hype, but you also miss the moonshots. 4. Value traps are real. Some companies look cheap, but it is a trap. Maybe the business model is broken. Maybe earnings are collapsing. Maybe the CEO just bet the future on a metaverse version of Minesweeper. The hard part? Telling the difference between deep value and slow death. So, where did I finally land? I built systems, created spreadsheet models, and tracked metrics like a monk tracks prayers. And the result? Even across all the events in the last decade, my portfolio stayed green. Just not go buy a yacht green, more like beat inflation and feel smart about it green. Eventually, I realized something. I knew what needed to be done. I just didn't have the time to do it consistently. And having come this far, settling for average didn't sit right with me anymore. So I thought, can I automate welding? Even if I am an accountant now, I do have a background in software engineering. I like to code and enjoy a challenge. So, could I build something to help me find value smarter, faster, and with less stress? Maybe I could train an algorithm to filter stocks more efficiently than I could manually. Or could I automate just enough of the process to free up my time without giving up control? I didn't know the answer, but I was ready to find out. Coming up next, before we dive into building intelligent systems, we'll take a short detour to explore the wild and wonderful world of stock tip providers. Spoiler, it involves questionable newsletters, overpromised miracles, and a few genuine surprises. Got thoughts, questions on value investing, or your own stock picking story? I'd love to hear it. Drop a note in the comments or message me on Substack at Tech Savvy Investor. Thank you for listening. I'm Saveen Kumar, and this is Lazy Genius Investing signing off. Peace.